Welcome back, guys, to another video, and this is going to be the last concept video for this particular chapter. So, as you must have seen in the thumbnail, we are going to talk about leverage. All right. And as you can see from the agenda, we are going to talk about what exactly is a leverage. And as given in your book, they have mentioned two ways, two examples wherein you can create leverage, and I'm also going to teach you how the formula which is given in your book was derived. And this particular thing, derivation of the formula, is not given in your book. But those who are interested, they can watch, or you can skip it. It's up to you. And lastly, fourth number, we are going to practice, because I believe in practice. Without practice, whatever you are learning will be hard for you to remember. So it's easy to understand the formula and the concept once you practice the example. So I want you to practice along with me. Okay. So, but before we begin, I have made a small 20 seconds video for you guys. I have put in a lot of effort. So I hope you will enjoy the video. I hope you enjoyed the small animated video. So the motive to show you that video is basically to tell you the meaning of leverage. So leverage basically means power, all right? So with the use, so in case of the video, the leverage was basically the fulcrum and the lever which the guy was using to move the big rock. Okay. Just like that, in financial term, we have leverage when we take leverage when we borrow money. Okay. Borrow money. So even if you don't understand this particular thing right now, it's totally fine. I'll give you example. You'll be better able to understand. So just from the animated video, what I want you to remember is that leverage is power. It can be both good or it can be bad also. Okay. Depends on how you use it. So leverage is nothing but power by which you can do big things. You can move big rocks. Okay. But it can work other way around. All right. So let's understand through an example how we as an individual take advantage of this power, which we are calling leverage in financial world. So if I give you a scenario of case one, you are a guy, okay, and imagine yourself, you are very wealthy. So you have, say, 100 million with you, and you invest it somewhere in some instrument or something like that. You are very smart. So you get a return of 10%. So 10% return on this 100 million will be what? $10 million. All right. Scenario two. So in the first scenario, you are using your own money. Okay. You are using your own money. You are not using somebody else's money. So in scenario two, you saw that since you are very wealthy, you already have this 100 million. This is scenario case two. Okay. Now you are getting more smarter. Now you see that, okay, I might, I will be getting a 10% return on my investment, and you can borrow money from the bank, another 100 million. And since you are very wealthy, the bank also trusts you and gives you interest, or gives you a loan at a very low interest rate. So say they charge you only 5% interest rate on the loan that you take. So you see that you can basically use your money as well as the borrowed money and invest it and generate a return of 10%. Okay. And that way you'll be able to make profit, because the cost of borrowing is less. The cost of borrowing is less than the return which you will be getting. So you can take advantage of leverage in such a scenario. So just to give you the numerical proof, so you had your 100 million with you. You took loan of 100 million. Now you have how much? 200 million with you, and you invest it and you get 10% return. Okay. Let's assume that you are getting this 10% return for sure. Okay. So you are getting 10% return, and this 10% you are getting on what? 200 million. So the profit which you will be getting is 20 million. Okay. But now you have to pay this 5% interest after a year, right? So this is also after a year. This 20 million is also after a year. This is also after a year. In our first scenario, this was after 1 year. Okay. So you are getting a profit of 20 million, but you have to pay the interest of how much? So after a year, what you do is you return back the principal, but you also need to return the interest or the cost of borrowing, which is 5%. And 5% of this 100 million will be how much? $5 million. So if I deduct it, I generate a profit. The actual money which was left with me as a profit is $15 million. After repaying this after repaying this whole thing, the principal and the interest, still the profit remaining with me is $15 million, which is higher than which is this one is higher than this, right? So what do you what do you conclude from this particular example? You can conclude that using leverage, that is by borrowing money, you can generate higher profit. Given the scenario that the cost of borrowing is less than the return which you'll be generating. Or, in other words, I can say that you can leverage only in such scenarios where the return where you'll be putting that borrowed money is more than the cost of borrowing. Okay. So I could be saying also like this, you even if you don't have any money, you borrowed this 100 million, you don't have any money, you borrowed it say at a 10% interest rate. Okay. So after 1 year, how much you have to pay principal plus 10% is what? 10 million. So you have to pay back $110 million. Okay. But you're very smart. You invested it somewhere and where you are generating 20% return. So the return is higher. So in that case, you put in this 100 and generating 20% return will be your money will become $120 million, right? And from this 120, you pay back this 110. Still, you generated $10 million as a profit without you putting your own money. So basically, this is what leverage is. I hope I'm making sense and you're able to grasp the concept. So let's understand one more thing. Let's understand the leverage return. Okay, let's write it RL, leverage return. So basically, you generated a profit of 15 million. So I'll just write 15 million. Okay, divided by, since we want to see the leverage return, I in the denominator I only will use my which one? Own money. Okay, so it will be 100 and 100, which will give me, my leverage return was 15%. So if this is confusing, it's totally fine because subsequently I'll be clearing this out. But main thing is, I hope through this example you understood the concept of leverage. Okay. And this is just as a teaser, you can say. All right. So leverage you understood. And as per agenda, in your book, there are two ways of creating leverage. What do I mean by that? Let's see. Okay. So in book, one way which we already have discussed is you can create leverage by borrowing money, which we did it in this scenario. Okay. You borrowed money and then you took advantage of that low cost of borrowing, and then you, using this leverage, you generated a higher profit. So in our animated video, the leverage was what? The lever and the fulcrum. So in this case, the leverage is what? The money that you borrowed, okay, and also the low cost of capital of borrowing that money, okay. So the main thing is, just like in animated video, I'm again repeating, the fulcrum, two things were there, fulcrum and lever. Just like that, here also the borrowed money and the low cost of capital are your leverage. All right. So I hope till this point everything makes sense. So in the thumbnail also I displayed you that leverage can act as a two-way sword. Okay, I'm going to tell you here now. So with that, I will also tell you the two ways of creating. One is this one, as mentioned in your book. Another way is by something called future contracts. You can also basically generate leverage by entering into future contracts. This is the second way. Future contracts. What do I mean by future contracts? Is you do a contract, you enter a contract. So since this is a future contract, you do it on stock exchange. All right. So what happens is, like, in the stock exchange or something, you want to buy an asset. All right. Which is, say, worth 1 lakh dollars. And you know that this, if you buy today, after a year, it's going to give you a return of 10%. You are confident about that. Okay. But since it is a future contract, future means basically you are entering into a contract with some other person. So usually in future contract, since it is a stock market, you will not know who that other person is on your other side, who you will be entering contract with. Okay. So stock exchange usually they act as a guarantor between two peoples. Okay, so you are on one side, somebody else is on other side. You both are entering into a contract. The other guy wants to sell, you want to buy. For example, in this case, I don't want to go into in depth with future contract, but I just have given you a gist. But the main concept which I want to focus is on leverage. So let's discuss that. So the thing is, you want to buy an asset which is going to cost 1 lakh dollars. And once you buy, you know that after 1 year, if I sell, I'll get a return of 10% on it. So basically this 1 lakh dollars is going to appreciate by 10%. So it will become 110,000. So you are sure about that. You are very sure about your hunch. Okay. So you want to do this. But since it is a future contract, it's basically a contract where you are saying, I will buy this asset after a year. Future means after a year. So you only need to put margin money. Okay. Margin money of, say, 10%. Okay. Don't get confused with this 10. I'll just write it in another. Yeah. So you need to put margin money. In this margin money, you need to deposit with whom? You need to deposit with the stock exchange. So the guy who's selling, he or she is also going to deposit the margin money so that the stock exchange is sure that you both are serious. So you deposited 10% of what? This margin money of what? Of this asset. So you deposited $10,000. Now, here the leverage works. So actually, you are putting only $10,000, right? But the return which you'll be getting after a year, you are sure that this 10%, I'm going to get 10% return. This return will not be on this margin money, but this return will be on the entire asset. Okay. So the actual return, if if there was no stock market, there was no nothing, if if this thing was not there, future contract was not there, if you had to buy this now and actually the value appreciates to say 110,000, you will only get the return of 10%, which is you are getting a profit of $10,000. And how much you bought the asset for? 1 lakh into 100. So you are only getting a return of 10%. This is the real return which you are getting. But we are talking about leverage, right? So when you are doing this future contract, the only original money or the real money which you will be putting is only $10,000. But if whatever you imagine came true, that okay, the return next year is 10%, then you will be getting this return on this. Okay. So let me clarify one thing also. Then why is the other guy selling it at whatever the rate? So everybody does not expect the movement of asset. Nobody knows, right, whether the asset will go up or go down. So it's up to one's own judgment by analyzing the asset or shares or whatever you are going to buy, right? You have to analyze all those financial ratios and study the company which you are investing in. So let's not go into depth in those. But yeah, the only thing, if you are confused that why the other person is selling you, everybody has their own judgment. So in this case, your judgment is that you are sure that you are going to get 10% profit, 10% rise in this asset because the company is doing well. So you, and the 10% profit which you thought it came true, then in that case, this 10% profit will be applied on this. So, but the actual money you put in was this. So let's see. Sorry for taking such a long time to explain. So 10% of this will be, your profit will be how much? 10% will be 4 zeros, right? So you generate a profit of $10,000. And what is the return as per our leverage? So what is the actual return? You only put 10,000, your principal, and you generated a profit of 10,000, right? Into 100, you generated a profit of 100%. Basically, what I mean to say is that you put in this much amount and you double your money. Double, right? You just doubled your money. Isn't that great? Using leverage, you can double your money. Had it been like you had to buy all this and then you generate a profit of 10%, your return would only be 10%. But using leverage, you generated a profit of 100%, or you can say you double your money. Okay, that's another way in which you can create leverage, which is given in your book. Going back to the thumbnail, what if you imagine that, okay, you want to buy this one lakh dollars, but instead of, you thought that it will give you 10% return, but what happened is after a year, actually the asset depreciated by 10%, or you can say 20%. In that case, what? You had put in the margin money of 10%, which is this much was the margin money. And if the if the asset depreciates by, sorry, if the value of the investment goes down by 20%, so 20% will be applied on this. Okay? Not on this, not on the margin money that you put in. So the loss would be how much? loss would be 20% of this value. So the loss would be $20 million. And leverage return would be loss is 20 by how much money you put in? 500. So you can see that loss is minus 200%. You have nearly double your loss. You already lost this much, whatever you put in, you also lost additional this. You have to pay this much to the stock exchange. Your margin money will to burn, right? You additionally have to pay this much. Then hope uh, it makes sense. So leverage is very dangerous. You have to be very smart when using it. But given the situation that your judgment is right and the cost of borrowing that money is very less in the future contract, it is cost of borrowing is not there, right? So you get the leverage could be high, right? So you can basically use the power of leverage, but nonetheless, it can work in any way. Now, discuss about let's talk about the derivation of the formula of leverage. Okay, so in your book, the formula is written something like this: leverage return is RL, and this RP is the portfolio return. Okay, you might not be understanding what I'm saying right now. BB is the borrowed money. VE is the your own money, equity, your own money that you put in brackets, right? Portfolio return minus cost of borrowing. Let's write it as in your book. It is written as D. Okay, this RD is the cost of borrowing. So this is what is given in your CFA book, and let's try to derive this book in a very simple manner. Sorry, this formula in a very simple manner. Okay. If you want to skip, I have put in the timestamp, and those who want to know, just hang tight with me. So, so this is portfolio return. Okay, and this is your leverage return, and this is your borrowed money, the amount of borrowed money. This is your own money, the actual amount invested. Again, portfolio, and this is cost of borrowing, which will be all right. So let's derive the formula. So so basically, your you put in your own money. In this case, I'm going to write it as equity E. Okay, plus since we are talking about leverage, you also borrowed money. Okay, let's write it as B, or you can, some people write it as debt D. Okay, so in this case, just for the sake of simplicity, I'm going to write B. And your own money plus the borrowed money makes your portfolio. So let's write it as portfolio E. So this P is that portfolio only. RP is the return on the portfolio. Hope it makes sense. So your portfolio is consists of your own money and also borrowed money. Okay. So I can write it as I can E plus B is equals to P, or I can write it as P is equals to E plus B. Hope till this it is clear. Let's name it number one. Okay, because this we are going to use it later on. So if since we are talking about leverage, Let me write it down here. P is equals to E plus B. We will be looking at two things. One is return on the portfolio. Return on the portfolio, I'll just write it as RP, okay? I'll denote it as RP. So these two are different. This P is the actual amount invested. This is the amount of money. But this RP is the return that you have generated on the amount that you have invested. Okay, so both are different. This one is return, this one is the actual money. And since we are talking about leverage, since you have borrowed it, say at the cost of R RB. Okay, cost of borrowing RB, because here RD is mentioned, but let's use RB only. Why to get confused, right? So again, I'm repeating, your portfolio consists of your own money and the borrowed money. Okay, these are the actual money. And when you invest it, when you invest this money, you generate return. So this return is this one. And since you have borrowed this money, this is the cost of borrowing. Hope till this point everything is clear. Okay. So if I want to say, since you have invested the entire money, if I want to calculate the actual return in amount on your portfolio, what would be the formula? So return on portfolio is what? So basically, if I say the principal is this, which is in this case P, and the rate of return after a year, you are very smart and you generated say 20% return. So the return on portfolio RP would be 20% of 100, right? So 20 would be the return. So basically what I'm doing, 20% into 100, that is P. This and this I'm multiplying. So I can write return on portfolio as RP into P. Can I write it like this, or I can write something like RP dot P? This is the return on the portfolio. Till this, I hope everything is clear. But you also borrowed money. Okay? You borrowed money, and because of that, you have to pay interest on the borrowed money. So, what would be the borrowing cost? For borrowing cost for the amount of interest that you need to repay back. That is the amount of money that you borrowed, B, right, into cost of borrowing. That is, in this case, RB. RB. Hope till this point everything is clear. Till now it might be confusing, but even if it is all zigzag and complicated and like here and there, everything is scattered here and there, don't worry. Don't worry at all. It's fine. You just I want you to just like understand the concept that is. So this is the money that you need to repay back, right? This is the amount of money that you borrowed, and this is the cost of borrowing. So this is the actual interest that you need to pay back to whoever you have borrowed, right? So you'll be returning B. Sorry. You'll be returning B. That is the amount of money that you borrowed. Also the interest. So the interest is this, and you generated the return of this on your portfolio. So the actual profit is actual profit. So profit left with you would be how much? Would be you generated a total profit on your portfolio of how much? This RP into P, right? Minus you have to pay this amount of money as interest to whoever you borrowed, B into RB. I hope till this point everything is clear. So this is the actual profit which is left with you. So what is the formula for leverage? Leverage leverage rate is the actual profit that is left with you, profit left for you or with you divided by your own money. Your own money. Okay. In this case, our own money was E only. So profit left with you will be this is RL, right? Profit left with me is this one RP dot P minus BRB by E. Mm, okay. I can write it as this as well. RP dot P by E minus P dot RB by E. I can write it like this, right? Now, till this point, let's hold it. It's almost done. Done. Almost done. You remember the this one, which we have marked it as 1. I am going to write that down here. Your portfolio was your own money and the borrowed money. I just want to divide both the left hand side and right hand side by E. I can do that, right? E by E plus E by E, right? So ultimately I can write it as this. So this P by E is equals to this 1 plus BE, right? So this P by E is also here. P by E. You can see, right? P by E. You can see. So instead of this P by E, I will write this. So I'm just continuing this. RL is equals to, I can write RP into P by E. I can write it like this as well. Minus BRP by E, right? So I can write RL, RP. This I will write as this B by E, RB. Now I can write it as RL, this multiplied with this multiplied with this. So it will be RP plus B by E, RP, right? Minus this one, B by E, RB. So I'm just writing it down. RL is equals to RP portfolio return plus this BE I'm going to take common. So B by E. So what remains RP minus RB. So this is the formula which is given in your book. In your book, it's written as this RP plus VBVE RP minus RD. Okay, don't get confused. So basically, this is the portfolio return. So whenever you want to calculate the leverage return, this is the portfolio return plus the amount of money that you borrowed by your own money inside the brackets, portfolio return minus the cost of borrowing. Okay. So this is the formula for the leverage. Now let's try to solve one question. So this is the practice question. You can try it before we do it together. You can give it a try. If you did it, then hats off to you guys. Let's see what do we have to do. Okay. So I'll just write down our formula. We have to an investor. Let's see. Investor creates this is the portfolio, and this entire portfolio is financed by, so 60% is equity, 40% is debt. Debt means borrowing, and the portfolio earns the interest, earns a 10% investment return over a year. Okay, cost of borrowing is 6%. So just by looking at this, you can understand that it is having a favorable leverage. Okay, favorable leverage. So it will be in profit. Calculate leverage return. So leverage return, which I can write it as RL. So RL is going to be RP, return on portfolio, plus the amount of money that you borrowed by your own money equity. Again, RP minus cost of borrowing. Let's write it as RB. Okay. So what do we have here in our example? So we have portfolio earns 10% return. So this is the RP. Okay. 10% you can write it as 0.1. So this is 0.1. And this will also be 0.1. Cost of borrowing on debt is 6% per year. So this will be 0.06. Okay. 6% we can write it as 0.06. What about B and E? So you have 20 million as a portfolio. 60% is equity. So equity would be how much? 60% of the portfolio of 20 million. So it would come to be $12 million. What about debt? Or I'll just write B. B is 40% of portfolio. Portfolio is how much? 20 million. So 12, 20. So it would be how much? 8 million. So this is 12, sorry, this is 8, this is 12. So if I plug in 0.1 plus 8 by 12, 0.1, 0.006. So I'm not going to bring out my financial calculator. I'll calculate I have physical BA2 plus calculator as well. I'll calculate it there. So this would be 0.1 minus 0.06. This will amount to, this entire thing would be 0.004. This you can write it as 4243, right? So it will be 0.1 plus 2 by 3. 2 divided by 3 would be 0.6667 into 0.04. So if I multiply this, it will come out to be 0.6667 into 0.04. This is coming out to be, so if I add 0.1 to it, this is 0.1267. So leverage return is how much? 12.67. This is the leverage return.